Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Tuesday, October 27, 2009. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 4:30 p.m. in Baden-Baden in Germany, where our friends are meeting for their annual conference. In London, it's 3:30 p.m. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. A long time ago, Benjamin Franklin described New Jersey as a keg tapped at both ends, referring to both Philadelphia and New York. Interestingly enough, tomorrow night the World Series will begin at Yankee Stadium in New York. They're playing the Philadelphia Phillies. Also, our sister company, the CATEX Global Exchange, has an advertisement today in the Insurance Day magazine. It's on page 3. Now to our main news. 3 former executives of Marsh McLennan were found not guilty yesterday of all remaining charges relating to an alleged bid rigging scheme. This is yet another vestige of former Attorney General Eliot Spitzer. The 3 defendants, Joseph Pizer, Greg Doherty, and Kathleen Drake, were accused of defrauding Marsh clients by arranging non-competitive bids. All had pleaded non-guilty to the 37-count indictment filed by Spitzer in 2005. The indictment accused the brokers of colluding with executives at several insurers to rig the market for excess coverage. The trial began last December in New York Supreme Court. 3 weeks ago, the judge dismissed grand larceny charges against the defendants, citing insufficient evidence. Back in February, 2 other Marsh managing directors were found guilty of violating New York's antitrust law, but acquitted on 20 other counts much more serious of fraud and larceny. Lloyd's has come out with its central fund numbers. They say that its estimate of excess of central assets over solvency shortfalls has increased by £51 million. This is since the end of June. It's up now to £2.5 billion. Lloyd's said that an increase of £16 million in subordinate liabilities since the end of June came from an unrealized exchange loss on the translation of euro-denominated debt, following movement in the euro rate of exchange from 1.17 down to 1.09. Lloyd's also said that the overall society's investment return for the 9-month period was a gain of £110 million. At the end of June, it was £20 million. We have a spate of earnings reports. W.R. Berkley, the U.S. insurer and reinsurer, this morning reported net income for the third quarter of 2009 of $98 million. For the third quarter of 2008, it had a loss of $28 million. Their result this year was helped by a $20 million increase in investment income during the third quarter of the year, as well as a big swing in investment gains, which were $4 million plus compared to $220 million negative last year. Net premiums written for the third quarter dropped to $969 million from $996 million. Total for the year, they were down to $2.9 billion from $3.1 billion. The group's combined ratio edged up a little bit to 90.5% from 89%. Bill Berkley will give this whole quote in full because of his reputation. Because of his reputation. The company's chairman and CEO said, although the insurance cycle has not yet turned, for the quarter, pricing on renewal business year over year is down less than 0.5%, and our premium volume is overall down less than 3%. He went on to say that at current pricing levels, with existing low interest rates, we believe that the industry is operating at a net loss on an accident year basis, and a turn in the cycle is inevitable. We anticipate modest improvement in the economy and a turn in the insurance pricing environment in the first half of next year. We continue to believe that we'll meet our objective of a return of 15% on equity. Patrick Thiel down in Bermuda could be saying much the same thing with Partner. Partner Re returned to a healthy profit of $566 million for the third quarter, bouncing back from a $152 million net loss for the same period last year. Partner's net income included after-tax net realized and unrealized gains on investments of about $274 million or $4.64 a share. Thiel said for the first 9 months of 2009, we achieved an operating return on beginning equity of 22% and a 30% growth in GAAP book value per share. So we'll keep on moving. Willis, too, came in with their numbers. Willis said that for the first 9 months of the year, their numbers rose to $359 million from $241 million. That's profit. Revenues rose to $741 million from $556 million, while for the first 9 months of the year, they increased to $2.4 billion from about $1.95 billion. For the first time, Willis also revealed that in the first 9 months of the year, it had cut 360 positions, costing the company a total of about $20 million. Late yesterday, there was some news that Hartford Financial Services plans to appoint Chief Financial Officer Elizabeth Zlatkos to be the insurer's Chief Risk Officer. The struggling life insurer is launching an external search for the CFO's successor. She's going to remain as the finance chief until a new person is found. Both the new CFO and Ms. Zlatkos will report directly to the new chairman and CEO, Liam McGee. McGee has said one of his priorities is to elevate the role of risk management. McGee, of course, is a former head of consumer banking at Bank of America. He took over from Ramanier, who announced his retirement last June. He's going to be retiring at the end of this year. Stock market is up about 63 points, despite some conflicting data, which we'll get to in a bit. Here's a word from our sponsors. You have some news that's just come in. 8 more American soldiers were killed in Afghanistan today, southern Afghanistan, by a bomb. This is on top of a total of 14 killed yesterday. 11 of them were soldiers, 3 of them were contractors. There was a front page story in today's New York Times on top of the fold on the left-hand side, pretty prominently placed, written by Mary Williams Walsh. And the story featured a very lengthy article on Maurice Greenberg. The title of the story was "Ex-AIG Chief is Back, Luring Talent from Rescued Firm." The story is available on the New York Times website, nytimes.com. I'll give you a little bit of a synopsis here of Ms. Walsh's story. Maurice Greenberg, who built AIG into an insurance behemoth with an impenetrable maze of on- and offshore companies, is at it again. That's the opening paragraph. Even as he had been lambasting the government for its handling of AIG after its collapse, Greenberg has been quietly building up a family of insurance companies that could compete with AIG. To fill the ranks of his venture, CV Star & Company, he's been hiring some of the same people he once employed. Now he may have received some unintended assistance from the U.S. Treasury. Just last week, the Treasury severely limited pay at AIG and other companies that were bailed out by taxpayers. According to Ms. Williams, this may hasten the exodus of AIG's talent, sending more refugees into Greenberg's arms, since Star can pay whatever it wants. According to Douglas Love, an insurance executive who's also hired AIG talent for his company,